During this video, we will discuss the basics of the U.S. tax system to help you understand the taxes that you pay not only this year, but over your lifetime. And while it is great to become educated, I strongly suggest working with a tax professional to make sure you're not only maximizing your tax situation, but doing it correctly and safely. The U.S. income tax system is a progressive tax system using marginal brackets. Generally, this means that the more you make, the more you pay. However, a big misconception with federal taxes is that you pay all your income taxes at the highest marginal tax bracket that you reach. But in reality, taxes climb progressively like stairs, and currently tax brackets range from 10 to 37%. So if you have enough income to reach the 37% tax bracket, that means a portion of your income is also taxed at the 10, 12, 22, 24, and 35% rates as well. Let's look at a quick example. Let's say a married couple files jointly and has $100,000 of taxable income for the year. This would put them in the 22% tax bracket. But instead of their tax bill being $22,000, their tax bill would actually be closer to $12,000. And here's why. Reviewing the tax tables given by the IRS, we can determine that about $0 to $23,000 is included in the 10% bracket, and about $23,000 to $94,000 is taxed at the 12% bracket, and the 22% bracket begins at a $94,000 of taxable income. So only about $5,700 of that $100,000 of taxable income is taxed at 22%. If you total all these numbers together, we get closer to $12,105. This is how we're able to calculate an effective or average tax rate. We'll take the total taxes paid and divide it by the taxable income, or in this case, our $12,105, and divide it by 100,000 to get 12.12%. So while the marginal bracket is 22%, the average tax rate is going to be a lot closer to 12, because that's where the majority of the income was taxed. Understanding this concept can help you make financial decisions that keep your average tax rate as low as possible. You can determine whether it's a good idea to make Roth or pre-tax contributions to your employer plan, whether you should do Roth conversions, and if so, should you do them while you're working, or should you wait until your income is possibly in a lower tax bracket in retirement? These decisions will likely change each year, depending on the tax code, your filing status, income, and especially your financial goals. I wouldn't stress about taking the time to become a tax expert, which is why it may be valuable to consider working with one. But I do suggest taking some time to review your 1040. The IRS 1040 form is the official document used to calculate your income and file your annual income tax return. Think about the 1040 like a tree trunk, and the rest of the forms are branches that lead back to it. Other forms such as Schedules 1 through 5, Schedules SE, Schedules A through E, and plenty of others. There is valuable information on each form, and they each tell a different story. The 1040 will show you how much income you have and where it came from, your adjusted gross income, which determines which credits and deductions you can take, your taxable income, which determines your refund and amount owed, as well as penalties you may have paid, and a lot of other information. Getting to know your 1040 can be invaluable in helping you keep your average tax rate as low as possible. If you are interested in gathering some extremely valuable tax knowledge for free, the IRS has modules that you can find by Googling IRS tax modules, and it should be one of the first links to populate. There are 14 different modules, and while studying this may not be the most fun you have ever had, I can say this will teach you everything you wish you learned in school before you started paying taxes yourself. If you'd like to have a conversation about your specific situation, feel free to go to greenspringadvice.com and you can book a one-on-one with me or anyone on the team. Thanks so much for watching.